Welcome back to the Deep Dive. It is Tuesday, February 10th, 2026. If you are looking at your screens this morning, you're seeing a lot of red, and honestly, the dashboard hasn't looked this conflicted in a long time.
It really is. It feels like a perfect storm of conflicting signals. I've been staring at the terminal all morning, and the mission for this deep dive is to figure out why all the economic data is screaming slow down
Right.
while the people in charge of the money printer are acting like the party is just getting started.
It feels like we're watching two different movies. In one, the economy's hitting a wall. In the other, everything's fine, and inflation is the only boogeyman. So, let's start with the number that really should have stopped the presses this morning. December U.S. retail sales. What exactly happened there?
To put it bluntly, nothing happened. And that's the problem.
Nothing.
The headline number was 0% growth month over month.
Flatline.
Total flatline. Now, for you listening, you might think 0 isn't negative. That's okay, right? But, context is everything here.
You have to compare it to what was expected.
Exactly. The consensus forecast, what Wall Street modeled, was for a bounce of positive 0.4%. The month before, November, we were up 0.6%. So to miss the forecast by that much and land at a goose egg, in volatility terms, that is a massive miss.
And this is December data. This is the holiday shopping season. If the American consumer isn't spending money in December, when are they spending it?
That's the seasonal context. But here's the deeper insight, the real aha moment. We're still in an inflationary environment, right? Prices are higher.
Right.
So if your nominal spending is flat 0% growth, that actually means the volume of stuff people bought went down.
Because the dollars they spent just bought fewer goods.
Precisely. So 0% nominal growth is actually negative real growth. The consumer has hit a brick wall. They are tapped out.
That's a crucial distinction.
Wow.
We are buying less and paying the same. And this isn't happening in a vacuum, is it? We've been tracking the labor market. I know you've been worried about the ADP numbers.
Right, you have to look at the ADP report. It tracks private sector employment. And if you look at the 4-week average ending January 24th, the private sector is only adding about 6,500 jobs per week.
6,500 jobs per week. For an economy this size, that sounds incredibly low.
It's anemic. It's barely treading water. I mean, that is not a growth number. That is a keep the lights on number. When you combine a cracking labor market with a retail print of 0, the recession signals are flashing neon red.
Okay, so let's play this out. Logically, if I'm at the Federal Reserve, I'm looking at this data, I'm thinking, uh-oh, the engine is stalling, we need to cut rates. But that is not what we heard yesterday.
Not even close. It's almost like they're reading a newspaper from 6 months ago. We had two major Fed officials, Hammack and Logan, on the wires. Hammack was explicit. He sees no urgent need to cut rates this year. He actually called the economic prospect favorable.
Favorable. With 0 retail growth, how do you even justify that?
It's the rear view mirror problem. Central banks are just notoriously slow to pivot. They are traumatized by the inflation the last couple years. They are terrified of cutting too early. Logan said she is still more worried about inflation than growth.
So they are fighting the last war? Terrified of the inflation ghost, so they keep their foot on the brake, even though the car has stopped moving.
That is the textbook definition of a hawk. But it's a dangerous game. Look at where yields are. The 10-year Treasury is at 4.143%. The 2-year is at 3.452%. If you hold rates this high into a consumer slowdown, you are tightening the screws on a patient that is already struggling to breathe.
And this brings us to the word nobody wants to say out loud. I feel like we need a dramatic sound effect here. Stagflation.
That's the trap. It's the worst of both worlds. You get stagnant growth, which we just saw, combined with sticky inflation that keeps the Fed paralyzed.
They're stuck.
Completely. If they cut rates to help growth, inflation might spike. If they keep rates high, the economy collapses. And the market is starting to sniff out this policy error.
But here is where it gets really interesting, because the Fed doesn't operate in a soundproof room. There's political pressure. We have to talk about the Trump factor.
This is where the macro picture gets really messy. Former and incoming President Trump is not being subtle. He is explicitly calling for rates to be 2 percentage points lower than they are right now.
200 basis points. That's not a tweak. That's a completely different monetary universe.
It's a chasm. But it gets more specific. Commerce Secretary Lutnick came out and said the dollar exchange rate has been artificially pushed up for years.
Okay, let's pause on that. Artificially pushed up. That sounds like he's accusing the Fed. Why does the White House want a weaker dollar?
It's all about fiscal dominance. It's when the government spending needs basically force the central bank's hand. The White House wants a weaker dollar because, 1, it makes U.S. exports cheaper, and 2, and this is the big one, it makes it easier to pay back our massive debts with cheaper money.
So the White House is effectively warring with the Fed's mandate. They're saying, we don't care about your inflation targets. We need a cheap dollar.
And the market is listening. Look at the dollar index, the DXY. It's hovering around 96.8. That's a one-week low.
Which is strange, right? When interest rates are high, the dollar should be strong.
Correct. That's Econ 101. But that correlation is breaking down because investors hear Lutnick, they hear Trump, and they're thinking a coordinated political effort is coming to devalue this currency.
So if you're an investor and you see the government trying to devalue the cash in your pocket and the economy is slowing, where do you put your money? This brings us to commodities. Gold.
The 5,000 handle. We finally made it.
It feels like we've been waiting for this for years.
Yeah.
Gold trading around $5,022 an ounce.
It's historic. Now, technically, we saw a bit of a pullback, about 0.74%. Classic buy the rumor, sell the news on that weak retail data. But if you zoom out, the floor has moved up. $5,000 is the new support level.
For someone listening who isn't a gold bug, why does $5,000 matter so much?
It's psychology and it's a signal. When gold holds above $5,000, it signals that the market has lost faith in fiat currency holding its value. It's the ultimate insurance policy against that fiscal dominance we just talked about.
And what about silver? Is it riding the same wave?
Silver is the wild child. It's showing way more volatility. It actually broke below $80 intraday, closed around $80.72. It was down over 3%.
That's a sharp drop compared to gold.
It is, but the volatility skew here is massive. When silver moves, it moves fast and hard. But the thesis is the same. If you believe in a debased dollar, these are the assets where capital hides.
Now, speaking of hard assets, oil is telling a very strange story. The world looks like it's on fire, but crude prices, they're asleep.
It's a fascinating paradox. WTI is sitting at $64.19, Brent at $68.53. I mean, these are bargain basement prices.
Right, because Trump has threatened to deploy a carrier strike group to the Middle East if Iran talks fail.
And the rhetoric is heating up. Trump's line is very hard. Failure equals military pressure. Historically, if a U.S. president even hints at that, oil spikes $5 or $10 overnight.
So why is it at $64? Where's the war premium?
Because of that retail number we started with, the demand destruction signal from the U.S. consumer is louder than the supply shock signal from the Middle East.
Demand destruction. Let's break that down.
The market looks at 0% retail sales and thinks recession. Recession means people lose jobs, they stop driving, trucking slows down, demand for energy collapses. The market is so convinced a slowdown is coming that it is ignoring an aircraft carrier.
That is a terrifying calculus. The market is saying it's more scared of the U.S. consumers stopping spending than it is of a war in the Middle East.
Precisely. It's a race between recession fear and war fear. And right now, recession is winning. But, and this is a big warning, if we do get a kinetic event, the short squeeze on oil could be violent. It could rip from $64 to $90 because nobody is hedged for it.
Let's pivot to equities, because even there's this massive split happening between the makers and the designers.
You're talking about the divergence between TSMC and the U.S. chip giants. This is a crucial story for anyone holding tech stocks.
So the numbers out of Taiwan first. TSMC.
A monster print, up 36.8% year over year. Revenue hit an absolute historic high.
Okay, so TSMC actually makes the chips.
Yeah.
The physical demand is booming.
The AI build-out is real, but look at the U.S. session yesterday.
Right across the board. NVIDIA down nearly 1%, Intel down 6%, Western Digital crashed over 8%. So, hold on. If TSMC is selling record amounts of chips, why are the U.S. companies that design them falling?
It's a valuation problem. Investors are looking at the sky-high PE ratios of the U.S. names and getting vertigo. They're saying, okay, the AI boom is real, but maybe NVIDIA isn't worth this much.
So it's a rotation.
Exactly. They are buying the picks and shovels, the industrial reality of TSMC, and selling the valuation froth in the U.S., a flight to tangible value.
And speaking of rotation, we're seeing capital move into a place that's been uninvestable for a while, the China trade.
It's the contrarian play of the year. You saw Alibaba up 2%. The Hang Seng closed up almost 0.6%.
And there was a big policy development with EVs and the EU.
Right. This is huge. The European Commission has accepted price commitments from VW for their China-made EVs.
Explain why that matters.
We were staring down a massive trade war. Tariffs, bans, the whole thing. This agreement signals a thawing. It removes a major tail risk for German and Chinese industrials.
So the geopolitical temperature is cooling in Europe, just as it heats up in the Middle East. And on a lighter note, I saw something about Seedens 2.0 in China.
Yes, Never underestimate a viral trend in Asia. It's a dance craze, and it has sparked a total frenzy in Chinese media stocks.
Wait, a dance craze in moving stocks.
It's moving them to the limit. Companies like Wanda Film are hitting their limit up, the maximum daily price increase allowed.
That's just pure speculation.
It is, but it tells us that speculative capital in Asia is very much alive. The retail investor there hasn't tapped out yet. The animal spirits are waking up.
So looking ahead to the rest of the week, what's on the calendar that could shake all this up?
We are walking into a minefield. All eyes are on Friday, the big one.
The non-farm payrolls.
The NFP. We saw the cracks in ADP. We saw the flat line in retail. Now the market needs to see if that translates to the headline unemployment number. If we see a big miss there, that Fed narrative of no urgent need to cut is going to collapse very, very quickly.
And we also have CPI data.
Correct. China's CPI and then the U.S. Inflation is the last card the Fed is holding. If it comes in hot, they're truly stuck in that stagflation trap. If it cools, they finally have permission to save the economy.
And before we wrap, one corporate move caught my eye. Google Alphabet is issuing massive amounts of debt.
Yes, 4.5 billion in sterling bonds and over 3 billion in Swiss francs.
So Google is sitting on a mountain of cash. Why are they borrowing money now?
It's a defensive masterclass. Big tech treasurers see the volatility coming. They see credit markets could seize up if we hit that wall.
So they're grabbing the cash while they can.
Exactly. They are locking in liquidity now. Plus, by borrowing in sterling and Swiss francs, they are likely hedging against a weaker dollar. The smartest guys in the room are battening down the hatches.
All right, let's bring it all home. What's the final thought here?
The paradigm is shifting. For 2 years, bad news was good news because it meant the Fed would save us.
But now
Now, with the Fed digging in its heels, bad news is just bad news.
we're caught in the squeeze. Squeezed by a slowing consumer, a stubborn central bank, and a political machine demanding lower rates.
Something has to give. You cannot have 0% growth and 4% yields with this kind of political central bank disconnect. Volatility has to explode.
So key levels to watch.
Watch $5,000 on gold. If that holds, the debasement trade is on. And watch $64 on WTI oil. If that breaks lower, the recession is here. Carrier strike group or not.
Stay liquid. Stay ahead of the curve. This is Global Macro Pulse.
Disclaimer, not financial advice.